Hi everyone, Steven Jackson with Integrated Wealth, back here to continue discussing the different types of tax status for most retirees that we see. So behind me here, we have the tax deferred bucket and the tax free bucket. Now in the last video, we went a little in depth on the tax deferred side. That is going to be your traditional IRA, your traditional 401k, and those types of accounts that whenever you put money in, you're able to see the benefit for that year that you're contributing into that specific bucket. This week, we are going to focus on this tax-free bucket here. Now, I would say it is one of the most misunderstood and most underutilized buckets that we see. There's quite a few different accounts here. I'm only going to discuss a few. First one being a 529. Now, a 529 account is specific for educational use. The reason it's in this tax-free bucket is you pay taxes on the dollars that you put into it. And once it's there, as it grows, as long as it's being used for specific circumstances, you don't have to pay any taxes on the growth, on the dividends, on the interest, capital gains, anything like that. Now, as the years have gone on, the 529 has become a lot more flexible. So we see a lot more people utilizing it for their grandkids, for their kids. A couple of those things are, hey, what if my child or if my grandchild doesn't go to college, what can I do with this account? A few misconceptions, that it's only able to be used for a 4-year degree. There are stipulations within it that you're able to use it from K through 12 for different private schools, but also you are able to use it for trade schools as well. And so that's something to think about as well. And lastly, something that I'd say is the most recent with the Secure Act 2.0 is you're able to take up to $35,000 from a 529 and convert it into a Roth. So if you're worried about your grandchild never using a 529, maybe because they're a star athlete or they get an academic scholarship or they decide to take a different path entirely and not go to university, the funds within there up to $35,000 can be converted into a Roth for them. And so that's a benefit for them. The benefits of putting it into that 529 is you do get some help on the state side when it comes to deductions, and you can write that off. But again, mostly that is growing completely tax-free. Next, I'm going to talk about an HSA just very briefly. Same type of situation, except that's on the health side of things. There are going to be contribution limits for this, whether you're single or contributing to a family HSA. But we have lots of clients coming in who have, over the years, contributed a lot to an HSA. There are certain rules in place that allow you to have an HSA. You have to have a high deductible health plan to be able to contribute and to have one of those. But I've never seen anybody head into retirement being unhappy with having too much in a health savings account. Okay, there's lots of different things you can use that for, including paying premiums for long-term care help. Now lastly, and this is where we're going to spend the most time, is a Roth. Now, a Roth, again, is one of the most misunderstood types of accounts, and a lot of people don't think it's accessible to them. A few things that you have to know about a Roth: to contribute to a Roth IRA, you have to have earned income. So if you're watching this video right now and you're retired, you're no longer working, you might think, okay, that time is behind me, can't do anything there. There are ways to put money into a Roth, and that would be through Roth conversions. We're gonna have a whole separate video on how to fund a Roth and all the different ways to do it, the benefits. We'll even do some case studies on showing you the benefits of, okay, if I put X amount into Roth every year before my required minimum distribution age, what can that Roth grow to? But right now, I just wanna tell you the benefits of having a Roth. A few different things. There's a Roth IRA, which is similar to a traditional IRA on how you fund it. You have to have earned income that you contribute each year. Pretty low limits of what you're able to put in every year. There's also Roth 401ks now. So if you are somebody who's still working and contributing to your 401k, contact HR, contact the plan administrator to see if there's a Roth 401k option within that plan type, because now your contribution limits are much higher. And think about it, you're putting money into this account that you never have to pay taxes on again. One of the ways that I heard it best described is over here, tax deferred is partnership money. Part of it belongs to you, part of it belongs to the invisible partner, the United States government. So whenever you pull money from a tax-deferred account in retirement, you're paying taxes on the total lump sum that you withdraw. Okay, so it's not just what you contributed into it, it's not just the growth, it's the total amount that you pull from it. Tax-free on this, you're basically buying out that invisible partner. And so you pay taxes on the dollars that go into your Roth. Once it's in the Roth, it is 100% yours. You're not paying any taxes on those capital gains if you're making trades within that account, any dividends, interests, withdrawals, things like that. And so there are a lot of benefits to having money on that side of things. And so three things that you can do with your tax-free account. Number one, distributions. So let's say you're retired before the age of 65. All right, and so for a lot of our clients, healthcare is a big concern there. If we are utilizing a tax-free account for your primary income source, then your income looks artificially low and you could qualify for a lot of subsidies when it comes to healthcare planning. If you're past the age of 65, you already have Medicare and you're not too concerned about that. Let's say you're pulling what you can from your IRAs and you want, an additional distribution, but you don't want to get kicked up onto the next tax bracket. You don't want to pay more for your Medicare Part B premiums. Well, any distributions from there are tax-free and you don't have to worry about that piece of it. Next, this is a very overlooked piece as well, related to the distribution side, but we actually have some clients who have such a big Roth that we're able to generate a lot of income just based off of their Roth portfolio. And so let's say somebody's done a great job of making conversions, of putting money into the Roth IRA, and let's say they have $500,000 within there. Well, let's throw it into a dividend type of portfolio. Maybe it's made up of some structured notes, ETFs that are kicking off some really heavy dividends and some really nice yield on some, whether it be a bond fund or an equity fund or some individual stocks. And let's say we're generating around 7% there on an annual basis of just yield coming in. On top of Social Security, on top of pension, on top of IRA distributions, you can get about $35,000 entirely tax-free if you're utilizing the Roth correctly and you're not even eating into the principal. Lastly, and this is one of the biggest things that we're seeing with clients now, because Roth is in fact the last bucket that we like to access. Once we get money into that tax-free bucket, we want to keep it there as long as possible because it is growing completely tax-free. Last video, we talked about how eventually Uncle Sam is coming for this bucket whenever you turn 73 with those required minimum distributions. So we know you have to draw that down anyways. So why not let this grow? Let the Roth grow over time. And more often than not, when there are assets left at the end of retirement, that it's going to be within the Roth bucket. So that means it's going to be a big legacy play to give to beneficiaries in that. So with the Secure Act 2.0, we know that we inherited IRAs. There's a 10-year period before those account needs to be entirely spent down. That means that your children are paying taxes on that when they're likely in the highest earning income bracket that they're going to be within their entire career. They still have 10 years to get rid of this, but it is entirely tax-free and they could wait till that 10th year. So you get 10 more years of that growth, meaning this has the longest time horizon, meaning that this will probably have the highest risk within your entire portfolio. The Roth will have the highest risk for that. One final point, just because this has been a concern for a lot of our clients as well, is if one of the spouses die, now the surviving spouse is a single income earner. And so they have less Social Security coming in. Maybe they have a pension coming, but they still have RMDs that they have to worry about if they're still a large tax deferred. If there is a Roth bucket that surviving spouse can access, that is going to be even more beneficial. So if you're worried about the taxes that your spouse is going to pay after you pass, Roth conversions might make sense for you, just knowing that, hey, all these what-if scenarios that are out there, you don't want to be kicking them up into those higher tax brackets just because now, unfortunately, they are filing single. If you're worried about that ticking tax time bomb whenever you're getting closer to those to that RMD age, I encourage you, reach out to us. We'd love to talk to you about Roth conversions. We do have some benefits over the next few years because of the bill that was passed last year, that we have a lot more for the standard deduction that we can move. And so if you have more questions about the Roth, please reach out to us, 330-896-1644. Thanks, and talk to you soon.